Thanks for staying on with Astro. AWANI, you're watching Notepad, and I'm your host, Ibrahim Sani. Yesterday, we spoke a little bit about the markets. Today, we shall carry on that conversation because the market is indeed moving very fast as we speak. So joining me is Stephen Ines, longtime friend of Astro AWANI. He's with the VM Markets, a managing partner there. Stephen, again, thanks for dropping by. I need to travel a lot now in Bangkok, in Singapore, and many other places. But one thing that doesn't move is on the news on the markets, because it's crazy the kind of volume that's coming in. And for the first time since 2008, the US Fed has indeed cut their rates, albeit a very minimal pricing strategy at 25 basis points. And they have been preempting this for quite a bit. What's your take on the US cut?
Well, you know, the markets were leading so dovish that the Feds just simply didn't even come close to market expectations. We saw a negative reaction, but really the negative reaction was all about the communication from the Fed, which was completely muddled, and I think that's what annoyed the market more than the fact that there was a 25 basis point. Now, to walk back and suggest that this is a mid-cycle cut, implying that it's a one-and-done deal, when only 2 weeks ago they were suggesting that we may have to remain on high alert because the waning global growth narrative, that was a shock. So right now we have about 100 basis points priced in to the yield curve in the U.S.
I understand.
As cuts. The Fed delivered 25 and may only deliver 50.
Yeah.
So this was
September.
Yeah, this was a real shock to equity markets. I mean, the way that the market was viewing this, it's, as far as risk-on performance, was really predicated on how dovish the Feds were going to be, and the Feds weren't dovish. In fact, it was a hawkish rate cut. So
no, even the vocab used was quite interesting. They said this is a preemptive strike. And then you preemptively strike it with 25 basis points, so nobody's going to jive the two text statements together.
Yeah, you know, they could have made a credible policy statement here. If they were targeting inflation, they could have come in and cut 50 basis points to see if that would have stoked the inflationary fires. If they were really worried about global growth, especially the fact that the manufacturing data has been so weak and that could spread into consumption, and it's consumption that's been holding up this global economy, then that's a problem. Is 25 going to solve?
Yeah.
No.
Yeah, you've been looking at the markets for over 2 decades, 3 decades even. And Jerome Powell is no idiot. He's a rather smart individual. Yet, the Fed and him coming across as very, I guess, pessimistic about what needs to be done. What changed their views? I'm sure something hit them, right?
I think they were conflicted simply because of the string of strong economic data that came out of the U.S., especially retail sales, employment data. Those were strong, and that suggested that you know, maybe they don't have to come in with the 50 basis point bazooka cut, and maybe they won't even have to cut down the road. But here we are now. We're still wondering, well, the global economy is still concerned about trade wars, and that's still a huge drag on global economies, but 25 basis points not going to solve the problem. So we're right back to square one as far as I'm concerned.
All right, let's look at the impact. It's been 2 days of trading in the US, 3 days here in Asia. The American dollar has indeed surged. Sell-off is currently happening in the US. Dow is down, S&P is down. And there seems to be some interesting uptake in the local markets. KLCI is actually up 4 points. Singapore as well, Hang Seng, as well as Thailand. Where's the correlation here? People are running there, putting it here?
Yeah, well, I mean, they were until the trade war came back into the fiasco again. What was really driving flows this week was a couple of things. One was the relative stability in currency markets. So when foreign investors make investing decisions, they really look at currency markets because they don't want to have to hedge any of the risk if the potential of a currency weakens the underlying investment that they're investing in. So using Malaysia, for instance, the ringgit has been very, very stable over the past few months. And that encourages investment. That opens you know, capital markets up. People feel less threatened. There's also this element that if the Feds did come out very dovish, it would give a lot more room for local central banks like the BNM to lower interest rates. This would create a really friendly inflow bond environment because you're going to have that chase for yield. And also lower interest rates are great for the domestic economy. So there's that thought that investors would start to buy local equity markets, but that seems to be put on hold again because of the escalation of trade war rhetoric. 300 billion of tariffs getting placed, or 300 billion
more
worth of goods getting tariffs.
today,
yeah, so this has just sort of ruined all the momentum that the markets have built up. This in spite of the Fed not even delivering a super dovish rate cut. Things were still positive. Now we're back to negative again.
Do you think that the Fed is, for the first time ever, cowed by the statements coming from the White House? Because we know how Trump views interest rate cuts, and yesterday even he was citing a bunch of analysts on his Twitter feed saying that it's a bad move. This whole 25 basis points is just ridiculous, according to him.
If we look at politicians across the world, there isn't one that wouldn't advocate a rate cut. Okay, all their constituents want lower interest rates. That's a given. President Trump's the only one, perhaps an Erdogan, that actually challenges his central bank openly, and that's the problem. Okay, so that creates a conflict for the Federal Reserve Board, because it sort of brings their credibility into question. If they actually followed President Trump and actually came out with a 50 basis point cut, that could have been viewed negatively. That could have been viewed as them cowering to Trump. They might have been better off not even doing anything, just holding rates rather than cutting. That might have been a statement in itself that the U.S. economy is fine. What's everybody worried about? But now we're sort of caught in this, what I call no man's land, and a lot of confusion that's emanating from basically a hawkish cut. And that's the problem we have right now. But getting back to the question about Trump, sure, he's been a thorn in in Jay Powell's side for many months. And this is a problem because when you start bringing in credibility issues with your central bank, it creates a whole bigger noise itself. And that's a huge problem.
But wouldn't people already know that Trump is unlike any other U.S. president in that sense that what he says carries lesser weight than previous presidents? Do you think that this is something that investors can shrug off? It's like, he's angry at the squad, the 4 U.S. Congresswomen. Now he's angry at somebody has to be a target, right?
Well, he's got the Treasury on his side. Okay, so Steve Mnuchin, he's got his ear, and that's a concern, because the Treasury can do quite a bit as far as manipulating the currency markets.
Policy,
yes.
Yeah.
So that's an issue. So you've heard a lot of rhetoric come out about trade wars. In other words, the race for the bottom in fiat currencies. As the Federal Reserve Board would ease, therefore every other country would ease to weaken their currency in tandem. We're seeing that with the ECB. We're seeing that, hints of that coming out of Japan, although I'm not really sure if the ECB or the Bank of Japan has any policy wiggle room left in their arsenal to actually manipulate the currencies other than just stepping back into QE. But the thought is here, if these central banks do move into the realm of QE, the US are going to respond by currency intervention. Currency intervention, how? Would they come out and actually start selling US dollars in the open market? Probably not. What they probably would be more likely to do is start buying bonds, Japanese bonds, Euro bonds, huge amounts of foreign bonds, and that would actually weaken the US dollar, and they wouldn't really be accused of currency manipulation because they're just going out and diversifying the reserves.
But the fact that they can use this as the threat of using this as a weapon clearly identifies them having a upper strength in terms of manipulating the monetary policy of the US. Well, just by saying that I can do this is already terrible enough.
Yeah, I mean, they control the world's economy, really, when
absolutely.
you still think about it. Like, I mean, you look at these escalations of trade war. Now, who's come out the winner? I mean, a lot of debate whether China's winning, whether the US is winning. If you just look at the first half's economic data, it's clearly the US are coming out ahead. And in my view here, it's their open economy is not really that susceptible to trade war. Everything's strong. Sure, the manufacturing sector is weakening, but manufacturing sector is weakening globally. That's because there's no capital getting invested into the markets. And also, if we factor in, we're at the tail end of the Trump tax bump. So that's also weighing on corporates because they've just invested or just used a lot of tax break money back into their companies again. Whether they put it back in the company or whether they bought their stocks again, that's a question mark. But anyway, that's an issue that we're dealing with right now. So the way I'm looking at the markets, there's one way. If we're really concerned about what corporates are doing, we have to keep an eye on what they're doing, not what they're telling us they're doing, what they're actually doing. So in other words, the Purchasing Managers Index, the ISM Index, these are forward-looking survey indexes, all came out weak. This is what they're saying they're going to do, but let's see what the proof is in the pudding, actually what they're going to do with this cheaper money that the Fed's put on offer.
Right, we'll take a short break. When we come back, we'll discuss a little bit more about the markets with Stephen Ines. Don't go anywhere. Thanks for staying on with us. You're watching Notepad. I'm your host, Ibrahim Sani. Today we are with Stephen Ines, the managing partner of VM Markets. Stephen, because of the proximity that you are at here in this part of the world, you can actually observe the current ongoings of the local markets and how it relates to the biggest, I guess, the biggest boy in town, which is China. How do you think China is reacting towards the current ongoings of the situation right now?
They're struggling. By any metric, they're struggling, but we're starting to see some base forming on some of the forward-looking metrics that don't really are yelling out for PBOC aggressive policy intervention, which might be a negative because we could really use a good dose of PBOC rate cut. And that's what the market really needs right now, but they seem a bit reticent to move down that road simply because of they don't want to inflate the asset bubble that they spent 2 years, quite frankly, trying to deflate. They were just unfortunately caught, sideswiped by Trump.
Do you think that Bank of Japan's move is going to inspire the PBOC to do something similar?
The PBOC are trying to strike their independence right now. They're trying to be autonomous from every other central bank. Obviously, one would have thought with a more lenient policy from the US, they would have just followed it in suit, but they're not.
Yeah.
That tells me that they're really more defensive about asset bubbles. They're really, really concerned about that. We look at the banking sector in general. It's actually struggling because a lot of the banks have run into some severe debt issues.
Yeah.
So they don't want to inflate that. What they want to do is probably be a little bit more prudent as to how they're directing their money in the economy. Now, we're looking at smaller non-state-owned companies.
Okay.
They're trying to direct money into them, but there seems to be an efficiency problem because the money's not actually funneling into them correctly.
Yeah.
So there's a lot of infrastructure issues they have to deal with, and getting the money into the right hands is really the problems that they're looking at right now. And I think this could be the reason why they're not releasing the so-called big bazooka, because they're not sure it's going to be effectively used. So I think once they rectify structural problems that they're currently dealing with, as far as the dissemination of money, then I think we're going to move into a more aggressive
So how long
policy.
do you think that will take?
This has been an issue in China for a long time.
Because people can't wait, you can't wait.
Well, they've been able to dig themselves out of a hole because they just keep on spend on infrastructure projects.
And the cash is in the trillions,
Yeah, but the problem is those infrastructure projects aren't being used. Like we have cities where nobody lives.
Pristine,
yeah,
7-lane highways.
Yeah, so, and nobody's using them. So, there's one thing to go out and spend, but there's another thing is spending for what if they're not going to be used?
Let's talk about manufacturing. A lot of the American corporates, in particular European corporates as well, are thinking of leaving China. Apple is one of them. They've already started trying out trial manufacturing of the Apple Watches in Vietnam. They've made statements saying that they're looking at some key Southeast Asian markets to build up manufacturing plants here. Do you think that this will in any way change how China views itself as a manufacturing factory of the world?
It'll have to. China wants to do it on their own, obviously. They want the Huawei's and their other big tech companies to succeed.
Yeah.
So they want to go down that route. But you have to remember it's a global economy we work in. It's not just an isolated economy. You have to.
But it's 1.4 billion human consumers within China alone.
I agree with that. Okay, I'm not saying that's not wrong. But there's the rest of the world who happens to like Apple technology. So what's the preference? Is everybody just going to give up their iPhones? Probably not, because that's the real status symbol in this part of the world, owning a brand new iPhone. That's why we see lineups still at Apple stores, and we can't deny that fact every time there's a new iPhone released. Now, what it's telling me here is that, the other parts of Asia are going to benefit from trade war. As we've seen on the metrics right now, as tariffs get moved up, even Chinese companies are moving proximity. They're moving into Vietnam. Basically, whether they're standing at the Vietnam border with a stamp saying made in Vietnam on it, that's one thing. But sure, there's a concern that other companies within mainland are looking to move to other places. It's just not the U.S. companies located in China. It's mainland companies themselves looking to move out to avoid paying tariffs.
Two big countries, in manufacturing and technology as well as in R&D, Japan and South Korea. They too seem to be going through an impasse between themselves What updates can you read from this?
You know, history is a funny thing when you start, you know, scraping back in ancient histories and, you know, dialogues between them that have been going on.
The
And
3,000-year-old civilization argument.
Yes, it just keeps on coming up here. But really, there is an issue here. Now we're dealing not only with a trade war east and west, we're dealing with a north and south trade war, which is even more damaging for the Asian complex as a whole. Now we're talking about two superpower export countries in the region, okay, that actually spread a lot of jobs through the region. Okay, this is a concern. I mean, these two should be at the negotiating table trying to hammer something out instead of Japan turning around and taking them off their approved list. It's a problem. How this is going to resolve, I'm not sure. Okay, it's a lot of politicking, it's a lot of saving face, but here we are again facing trade wars, north and south, east and west, and before we look again, we're going to start having trade wars with Europe. So it's going to be U.S. and Europe. So the world's going to get into a trade war. Yes. So we're just going to end up defeating the entire purpose of having an open global economy.
With Boris Johnson in the mix.
Which is just completely bizarre. I don't think we ever had any idea that we were going to go this far down the road when President Trump took power and he brought in the hawkish trade boards, the hawkish trade administration. We've got ourselves in such a mess. I don't know how we're going to dig ourselves out of this one.
All right. Let's dig ourselves out of this interview. We'll go for a short break. When we come back, we'll discuss how investors could react from the current market's ongoings. Don't go anywhere. Thanks for staying on with us. This is Notepad. I'm with Stephen Innes. Stephen, of course, there's two classes of investors, retail investors and, of course, institutional investors. How would the paradigm between these two groupings be made in the current context of the situation right now?
You know, retail investors are struggling in these volatile environments because they tend to over-leverage their positions a lot. It's not like the real institutional investors that pretty much use the house as cash. And because we see these big moves on equity markets, they can find themselves getting sort of whipsawed badly. And that's because of the unbridled use of margin accounts. We've seen smart moves by MAS to reduce leverage on a lot of positions. We're starting to see this go global, and I think it's a great, great move. If you look at professional traders, very, very seldom do they ever use more than 10% margin. Okay, we've got investors in the retail community leveraging up 400 times. And that's just, you know, a problem waiting to happen because it doesn't take a big market move to have them completely wiped, their positions completely wiped out. That's the one thing. But given the volatility, we've seen a substantial decline in both markets as far as volumes. Trading volumes are down. Bank volumes are down if we just look at the events that have happened over the last couple of weeks, even with Deutsche Bank pairing a lot of their equity sales and traders. And
they shut down that shop.
Yeah, completely. We're seeing similar trend from other banks. I'm hearing rumblings from similar trend from other banks, although I can't confirm which banks I'm hearing that from because I would be adding to the rumor mill at this point. But I think this is a global trend, and I think what it all boils down to is two things. One, retail traders are becoming a bigger factor, okay, simply because accessing the market through technology is a lot more readily available now. They can actually trade on institutional market spreads. Whereas if we look at institutional markets, the exact opposite is happening, where they are now downsizing because of the advent of technology, because all of their execution and a lot of their trades are getting done algorithmically. So this means you don't need a sales force, and this also means you don't need execution traders. So this is why these desks are getting down. Certainly there is a need for voice traders for executing big block orders quietly, but that's very, very limited. Most of the transactions are getting executed electronically right now, and that's why these banks are shutting down.
Let's talk a little bit about robo-advisors and ETFs. Very recently I spoke to a fund manager, and he argues that while, say, for instance, the retail investors, including institutional investors, when you invest in ETFs, yeah, sure, you're going to follow the market, you're going to get 3%, 6%, you're going to get that kind of returns, and it's safe, and you just track the market. But what you're doing is that you're concentrating the funds to just these top 50 companies or so, meaning that 97%, 98% of the rest of the companies on the indexes, on the stock exchange, is actually deprived of capital, and therefore you're not doing anybody a favor, not even to yourself, because if you actually invest in management, in the products and the services of a company, you can actually get more value, and it doesn't take that much of a brain power to get to know which one works, which one doesn't. What's your view on this?
I think it's an interesting concept, there's no question, because it brings in a broader base of clients that may not have entered the market. They may feel a little bit secure, but I totally agree with the assessment that it could sort of centralize a lot of investments in a smaller number of products rather than a broader number of products, which I think over the long run would be quite damaging. We also have to look at the fact that we see algorithmic trading almost run the same way in the institutional markets. Like everybody's almost trading the same, and it gets that crowded, that whole investment area gets crowded. So if all the robo-advisors are trading on a similar styled algorithm chasing those same ETFs, well, what's to say when one ETF starts to struggle, it will not cause
a cataclysmic knock-on effect for the other ETFs.
This is what we have to be careful with when the markets
Now that's the doomsday, I guess, theory.
Yeah, that's when the markets all start trading in the same way and in the same products, the space becomes crowded, and this is what we have to be concerned with.
So what do you think? What's your recommendation? I know your lot is like, hasten or catch yourself against advising.
Yeah, I mean, this is the big thing, is that it takes that element of sort of relying on a broker, okay, out of the market, okay? Any people that sort of had a bad run or felt that they were sort of ripped off, to use a Donald Trump phrase, by their broker, would feel a little bit easier perhaps using these robo-advisors, because they're very low risk.
Yeah.
So this is probably a little bit safer for the mom and pop type investor. But we have to remember that people do invest to beat the markets. If you just wanted to get the market, just go out and buy a Dow index. You don't need a robo-advisor. What people want to do is have solid investment advice from qualified sources. And I think this is why there's still some appeal for expert advice in the markets. And I think there's always going to be a place. This could be a fad, it could not be a fad. I think we have to keep our eye on it.
I don't think it'll be a fad. I think this will be the way forward. So let's talk a little bit about VM markets right now. We don't have much time left. But what do you guys do?
Well, we're expanding our base. We have an educational portal that we're bringing in a lot of clients to learn from a group of knowledgeable traders. We have several expert technical analysts that frequent our live trading room, is what we call it. We have quant analysts that are willing to help out with any issues that designing programs for traders. And we also have fundamentals. We've got 7 analysts that participate in our live trading room, so it's actively involved. We're just starting to build up. We're listening to what our clients are telling us. We partnered up with several execution brokers. We're trying to get a good handle on what our clients want to eventually build out our own execution platform.
But sometimes they don't know what they want, right?
This is what we're really finding, is that the clients are very, very fickle. They seem to change by the direction of the wind.
And the reason is because they don't know what they want.
Yeah, and this is part of our educational process.
Yeah.
So what we've done is we've got 3 different levels of education process. We're beginning, intermediate, and expert.
Yeah.
And we try to encourage our traders to go through the process. It's a very, very good process. It's something that we spent a lot of time building from our experience as expert professional traders, going through each step slowly. And we sort of made it a little bit of a reward treat where we actually assign, different grades, captain, lieutenant, general.
Oh, okay.
A little,
so you gamify it a bit.
Yeah, just to give it a little bit of fun.
Right.
And we're finding that, especially here in Asia, they're actually liking this kind of format, because it's sort of like a good thing when you see general coming in and giving a trading signal or giving some advice, you'd see a lot of people flocking to him. What we're trying to stay away from is giving trading advice, okay? We think on this platform it's very important that investors learn how to do it themselves instead of copying somebody. So this is the methodology we're trying to teach.
So how can people reach you? Is there a site?
Yeah, there is. It's got valormarkets.com. We're on Twitter, VM Markets, at MarketsPTE. And that's the best way that you can reach us right now. Valours, VALOURS, markets.com.
All right, fantastic. That's my conversation with Stephen Innes, the managing partner of the investment firm VM Markets. If you've missed any part of this interview, just head on to AstroAwani.com, search for Notepad. All these kind of interviews are there. You can also watch and listen to these interviews on anywhere you get the app, especially on Google Play and the Apple App Store, as well as on Spotify. Till then, thanks very much for watching and goodbye.
I said Valour Markets.